Stephen Meade again, back with another Bullseye Guy podcast. Fortunate to have Karl Sjogren. We're looking for the umlaws, but even though they don't show up on the internet, and his name spelling is not the name pronunciation, but I think we've got it right. And if you could see over the background, he's got the beautiful Golden Gate Bridge. And unlike many of us with our fake backgrounds, he's actually in San Francisco and Silicon Valley. So Karl, welcome to the show, and give us a quick little introduction on yourself, and we'll go from there.
All right. Thanks, Stephen. Nice to be here and join your audience. So I've done consulting, CFO, worked with startups and turnarounds for about 30 years. I wrote a book that came out last year called The Fairshare Model. And whoops, I don't know how that.
There we go. Now we got it.
Okay. So it's what's the focal point here? There we go.
You had it a minute ago. We saw it. We saw the cover.
All right. So it's I say it's about a performance-based capital structure for venture stage initial public offerings. I say it's reimagining capitalism at the DNA level because it seeks to balance and align the interests of investors and employees. And by employees, I include founders. The former chairman of Silicon Valley Bank called it an important work.
And so with your background, Karl, we had started actually before the podcast that you're actually from Detroit. I was hoping to get this great, European story, but talk to me for a minute about Detroit. There's something fascinating about where Detroit used to be kind of a center of innovation. There's some conversation around Silicon Valley and now some transitions out, but share with me what you were saying earlier about Detroit.
Well, when I was growing up, it seemed like it was, in hindsight, the equivalent of Silicon Valley in terms of a source of inventiveness. It was a draw on all sorts of talent, both domestically and internationally. It was the center point for affecting the position of the economy and position of the United States in world affairs. And I saw it shift. I remember going with a friend visiting the Detroit area sometime in, I think, the early 90s, and going to Canada to watch a Shakespearean festival. And on the way back, instead of going through the normal freeway system, we decided to take surface roads. And I was just struck by how you had these grand homes and other types of buildings that had basically been abandoned or weren't really being kept up. And I began to take a look at, just noticed some of the main boulevards where there used to be hardware stores and different types of enterprises. They were hollowed out too. And what I came to sense was that it was the development of the freeway system, basically trenches going outside of the city into the suburbs, that it sort of cut out the vitality of the city. You didn't have people transiting on the surface roads from downtown to a suburb or a distant area of the city. You basically had people bypassing areas, and it began to cut off the blood flow, if you will, of commerce. And there were other reasons for that. I think there was also this deterioration or this calcification of the relationship between capital and labor that we saw in the industrial age. Oh, and the other point I made to you was it seemed like the transition from, my personal transition from the Detroit area to the Bay Area happened around the same time that we were transiting from an industrial type economy to one driven more by electronics. So it just gave me a different, unusual perspective because I had one foot of growing up in what was, for 3/4 of the 20th century, the equivalent of Silicon Valley. And for most of my life, I've been in the Bay Area, where it clearly was the nest for a lot of different economic developments. And as you pointed out, it seems like we're going through another change again, with some firms migrating from the Bay Area. We've had moments like that before. And my suspicion is that there'll be some adjustments, but this will still be a place that attracts entrepreneurship, and people want to enjoy the sites that you see behind me.
Yeah.
But there'll be more competition.
It's interesting because I moved from Chicago, which is a kind of a Midwest industrial hub, and my family's in automotive and built automotive plants for years. So I've watched that transition of Detroit and the Midwest. Looked at moving to Silicon Valley years ago, and then I was just in Malta a year and a half ago with Tim Draper, who's one of the big VCs in Silicon Valley. Yeah. And I made the argument, somebody at Malta asked him, what could Malta do to be like Silicon Valley? And Tim's comment was, oh, you can't do anything, you can't replicate it. And I looked at him, I said, to me, Silicon Valley was fascinating. It was not the center of innovation. It was actually the center of investment. The innovators moved to Silicon Valley, and don't get me wrong, they have a fascinating machinery and a process, but that process has been broken with financing outside. Now COVID's accelerated a lot of the movement. So I think there's a transition out of not only Silicon Valley, but I want to move into some of the stuff with the Fairshare model. I think companies are really going to have to look at how they do business differently, how they look at their valuations, how they look at their structure. So within your background, Karl, let's go a little bit back. Let's talk about some of the work-related history and what sort of led you into the Fairshare model. And then we'll talk about what it is and how it works with companies.
All right. Before I answer that, I just want to acknowledge what you said and just underscore that complex systems are complex. There's many different inputs. It takes a lot of different subtle things working together in ways that we don't necessarily always understand. An entrepreneurial economy needs capital, it needs entrepreneurs, it needs people who are interested in working for them. They need customers who are willing to take a risk and being early customers and tolerate failure. And so in any complex system, it's hard to dissect and say, okay, if I can replicate this one piece, everything else is going to work. So I think that's a general challenge for systems generally, and also for regions that are trying to replicate the Silicon Valley model.
Well, I agree. We'll stay on that thread and then we'll move forward. When I looked at moving, Chicago came to me years ago, said, hey, what could we do to be like Silicon Valley? And I looked at Silicon Valley and the ecosystem. I looked at the Dellionaires in Austin and the Microsoft millionaires. And to your point, Karl, Silicon Valley was fascinating when they retrenched in the 70s and lost a lot of the aerospace. The webs came together where now you have this ecosystem where there's specialized early stage investors, and there's guys that'll leave companies and go to early stage, and there's press and there's PR, and there's layers of services. It's not just money infusion. Like Chicago had a lot of money, but they didn't have early stage capital and they didn't have risk taker employees. So the web of complexity for companies to be successful, Silicon Valley is still one of the best, but it's changing.
It is. And again, it's gone through, I remember when I came, it was at the beginning of the PC era. And toward the end of the 80s, the proliferation of small companies that were creating devices or consolidate. And it seemed like it was more of a big company play, and in some respects, as it seems right now. Then we had the growth of client server. Networking was something that affected the environment, and then in the mid '90s we had the internet, which changed things again, and social media. So there is a perpetuality of change, and I think maybe one thing that areas need to consider is how adaptable are they to new things. Do they accept it? Do they greet it? And do they have enough elements there to make something new work? And I think one of the areas that we're seeing right now is blockchain. We'll see how that plays out.
Yeah, that's we moved into that blockchain area in 2018 and looked at all these jurisdictions around the world and looked at Silicon Valley, and we looked at Singapore and Bermuda and Bahamas and Zug, and we settled on Malta for a multitude of reasons, but again, there's a lot of factors that come into account for companies that are in a startup phase or a growth phase or IPO, like the level of education, management, talent, execution all has to rise as you grow. And again, so moving back on you, Karl, what's some of the stuff in your background that you've done before that led you to the Fairshare model, where we can talk about, the transition of how the book came about and what it does?
So I'll just jump right into where the origin story was. In the mid '90s, I was doing consulting CFO work, and I had 2 stints with a company that was in the environmental technology business. Had some pretty cool technology, but venture capital firms were not eager to invest in that particular sector because nobody was making a lot of money, and the internet was starting. So it was a company that relied on angel investors, and it did pretty well. It raised about $2 million over 3 years or so. But in one of my stints, I could see what a struggle it was, because the checks would come in and $10, $20, $50,000 chunks, but you never know exactly when they were going to come, and it was difficult to plan, and there was an enormous amount of energy put into pitching. And I remember lamenting to one of the other consultants there about how inefficient it was. And we began talking because he had some basic ideas about what a different way to raise capital. Basically, he wanted to link together investment clubs around the country and make it possible to pitch offerings to them. So there are different reasons why we decided at one point, once the Securities and Exchange Commission decided to adapt securities rules to the internet, that we would start a company called Fairshare. And our idea was to form a online membership of investors, give them education about deal structures and valuation. Once we got to a critical mass where we could take down offerings, we would tell companies that if you had a legal offering, if you passed due diligence, if you used our deal structure and you allowed our members to invest as little as $100, we'd give you free access to pitch your deal. No commission, we wouldn't handle anybody's stock or cash. So it was basically a buyer's cooperative model. So I underestimated how much time and effort would go into dealing with regulatory concerns. They were solvable, but they were issues that kind of basically interfered with our growth. And then we had the dot-com bubble burst, and then the telecom bubble burst, and people's interest in investing in new companies was on the wane. And at that point, I had spent about four or 5 years dealing with various aspects of Fairshare, and I was getting a little worn out. So we slipped underneath the waves, if you will. So that was the origin story. Fast forward to the Great Recession, and there's talk about a need to make it easier for startups to raise capital. And one of the chief products of that was the Jobs Act, the Jumpstart Our Business Startups Act. And I thought, well, gee, that would have been a good time to start Fairshare, because clearly the regulatory climate was changing. There were more people who were interested in investing in early stage companies. People were going to college and getting degrees in entrepreneurship. There was more awareness of the word valuation. So I thought, and crowdfunding was a phrase that was being ballyhooed around.
Right.
I thought that was a pretty good description of what we were trying to do with Fairshare. But I thought, surely somebody else is going to pick up on the idea that we had. And I watched for a couple of quarters, and I saw that all the talk about innovation was about new ways to sell stock. Nobody was talking about new ways to structure it. So I decided, I don't think anyone else is really going to come up with this. And I put some thought into this with my Fairshare work. I'll write a book. So that was the origin of the book. And
so for people that are deep in the finance industry, which I have, kind of this arc of involvement, technically the initial crowdfunding, Kickstarter from Yancey and Indiegogo, that was more gift funding. It wasn't stock or equity. The Jobs Act sort of helped create the momentum to allow smaller investors to come in. So it's a type of crowdfunding, but then it tied into the stock and equity. And that's really more of what you're talking about is on the stock side, right? Because I distinguish crowdfunding to the old stuff, which was the gift reward. Then the Jobs Act came out. Now there's actually new technology platforms. We're doing stuff in blockchain and crypto where you can direct finance to your consumer. Technically in the stock world, it's called a direct public offering. And so now you can sell direct with a lot of things. What have you seen that's changed within the crowdfunding space, and what can somebody take away within some of the elements of the book that are relevant to what's going on today?
Well, I have a chapter on crowdfunding. I basically point out that crowdfunding has been around in some form for an awfully long time. There's basically 4 types. One is for services, and that's something that Ben Franklin actually was noted for doing when he was starting a printing press. There's for a cause or contribution, Statue of Liberty. The base in New York City was funded using crowdfunding, and even a statue in France. There's credit forms of crowdfunding, Kiva, but the equity funding is really what we're talking about here. And that term crowdfunding kind of drives me nuts a bit, because it's not clear whether it's a what or who or a when or when. So yeah. by mean what, if it's a what, it's a specific form of an offering, Form CF, which is allows companies to raise up to a little bit over $1 million. It's different from an S1. It's different from a Reg A Plus offering. So if it's a form of an offering, that's a possibility. Is it the method of selling? Is it something that is only available directly from the issuer? What if you have a broker involved? Does that obviate the ability to call it crowdfunding? And then there's the who part. It sort of presumes that it's an offering that's been sold to average investors. But what if it's just sold to accredited investors? I've heard people talk about crowdfunding for angels, which is sort of a oxymoron, I suppose, because they've always had good access to deals. So crowdfunding, to me, means that it's an offering of any type. It could be an S1, Mondo offering. It could be sold in any way. It could be sold direct or through broker dealers. And it could be sold to anyone, but average investors have an opportunity to invest a significant portion. So I'd say anything over 15% of the offering, if it's available to average investors, as opposed to the best customers of the broker, that could qualify as crowdfunding.
And again, for people that are in it, there's a difference between accredited investors based on financial qualifications, non-accredited. Then, the difference between a Reg A and an A+, there's a certain number of accredited and non-accredited investors that can be in some of the deals. And that's also what the Jobs Act really tried to open up, was allowing more average, I'll call average, not in a pejorative way, but kind of, average non-accredited investors to participate in deals. The Jobs Act, we actually helped work on that. Wasn't that 2012, 2013? It seems like a long time ago that it was being talked about and implemented. How long ago was the Jobs Act implemented, and do you think it's been effective?
Well, there were different parts of it, and even though it was all approved in 2012, it didn't all get rolled out in 2012. There was some things that took place, like the ability to have non-broker dealer platforms sell stock, and test the water provisions, and a rule CF for small offerings. Those were pretty much effective within about a year. Some of the platforms, some of the things took another year or two, because the act presented a sometimes apparently indigestible mix of rules or requirements for the securities regulators, which is basically we were all for better capital markets, but we want to protect investors. And there's this dilemma, this tension in the regulatory environment of capital formation is a critical part of growing an economy. You want to have people be able to participate, but you don't want people to lose money. You don't want them to be abused, and because they're new to it, they're not sophisticated. Because if they do take a loss, it's going to have a much greater effect on their financial well-being. So this is always a problem. But I'd say the Fairshare model really is I described the model last year at there was an event at Stanford Law School about crowdfunding. And one of the panelists was a then current member, a commissioner at the Securities and Exchange Commission. And I described the Fairshare model for him, and his reaction was, "That's great." He loved it because it was dealing with deal structure and basically making a risky investment less so, if you will. I draw a distinction in the book between I say there's two types of risk that venture stage investors assume. One's failure risk and the other one's valuation risk. Failure risk is the risk that the company is not going to meet operational targets it's set for himself.
Right.
And metaphorically, I could say, It's the risk. I say I'm going to jump to the top of my head. The risk is that I'm somewhere between the top of my head and the floor. You can deal with failure risk best by due diligence, but if you're in the company, you can try to influence management. If you're a significant enough investor, you may be able to use corporate governance to affect outcomes. But basically, if you're in a private deal, you're stuck. You're on a toboggan run until it plays out. If it's a public company, you can always sell your shares. Valuation risk is the risk of overpaying for a position. And you can overpay for a position in a company that meets all of its marks. Tesla is probably exhibit A on that argument.
Yeah, it always is.
But the point is that the startup world is full of failure risk. But wouldn't it be great if we could lower the valuation risk? So metaphorically, I say the failure risk is like a game of roulette, the odds of hitting a winning number. So valuation risk is the risk of overpaying for a position. And you can overpay for a position in a company that hits all of its marks from an operational standpoint, that has low failure risk. Tesla is a good example. So to continue with the roulette analogy, failure risk is the game of roulette, and the cost of the chip is the valuation risk. So what the Fairshare model does is reduce the cost of a chip, say from $50 to $5 or $1.
And how do you go about that? How do you, because especially as an entrepreneur, valuation's always a tough one. And there's so many different structures out. There's safe models and future equity. I like to price the rounds when we do it.
Okay, so this is the heart of it. So I say there's 3 equity structures out there. 2 of them are conventional. One's a Fairshare, and the third one's a Fairshare model.
Okay.
The 2 conventional ones, when I mean conventional, in part it's just what's used all the time, but it's conventional at the time of an equity investment to set a value on future performance. Mm-hmm. The pre-money valuation will reflect that. So that you have discounted cash flow and things like that influence it. The Fairshare model is unconventional because it puts no value at all on future performance at the time of the equity investment. Instead, there's agreement on how to reward future, what performance is and how to reward it. So just to back up for a moment on the conventional capital structure. A conventional capital structure generally has one class of stock, and it's usually what's used for an IPO and in some private offerings where there's not sophisticated investors, maybe friends and family type things. So one class of stock. And there's an agreement on pre-money valuation, value of future performance. What venture capital funds and private equity funds do is they'll also use a conventional approach. They'll set a pre-money valuation that estimates the future value, but they'll modify it with deal terms that mitigate valuation risk. Deal terms that if that future performance isn't as expected, they basically get a larger share of the company or a larger part of the payout.
Okay.
Deal terms I'm talking about are could be a valuation risk, could be a price ratchet, maybe a redemption right. There's various tools in that toolbox, but they all have the effect of reducing valuation risk. The Fairshare model is unconventional because it puts no value at all on future performance at the time of the investment. And to be clear, it's for an IPO. This is how it works. And it's a venture stage company, so it's hard to value. So In the Fairshare model, there are two classes of stock. Both vote. One trades, one doesn't. The investors get the tradable stock. That's the IPO investors and the pre-IPO investors. Employees get it as well for value generated as of the IPO date. But for future performance, the employees, and I'm including founders in there,
Okay.
get a voting stock that cannot trade. It converts into the tradable stock based on milestones they describe in their prospectus, or subsequently both classes of stock agree on. Now, those performance criteria can be whatever the company says and that investors buy into. Broadly, I suggest 5 categories in the book. One is a rise in the market value of the company measured by the tradable stock. Another one could be developmental goals, could be the release of products, could be progress making it through FDA testing if you're in biotech or food. Financial measures, sales and profit. Fourth measure could be the eventual acquisition price, if there is one. Say the company's acquired 4 or 5 years after the IPO. It's obvious then what value the employees created with their labor using the investor's capital. So they will reassess how to split that. But intriguingly, it could even include measures of social good. Impact investing is something that has captured the imagination of a lot of investors and entrepreneurs in recent years. And this is a way where there could be a mechanism to reward achievement of some important social goal, maybe removing plastic from the ocean or something.
So let's go through the arc here real quick, Karl, before we wrap up, because it's when we talk about crowdfunding for the most part's early stage, angels, startups, the valuations are always a little tricky. You move into an A round. A rounds traditionally, historically, are still early product revenue. B round is your expansion round, and C is your either big growth or pre-IPO, where you've got different classes and different shares. Where if you're pre-IPO, as you were talking about, you're talking about a much more mature company, maybe 2, 3, 4 rounds of funding. What's the classification of a fair share stock against founder share A, B, C, whatever these different rounds are?
Okay. So again, it's for public offering. It could be any amount. It could be for $1 million or $100 million that's being raised. So what happens in a normal conventional IPO is that you have common stock that the employees have and multiple classes of preferred stock for each round of funding, right? And then at the close of the IPO, the preferred stock converts into common stock based on whatever terms was issued to that preferred stock. And that's all the stock that the company has as of the IPO until it sells in its shares. In the fair share model, what would happen? Let's say you have a company that has raised $5 million in private capital, $10 million, and there's 3 classes of preferred and some common. What would happen is the preferred shares would convert into the common that's going to be sold at IPO, using whatever terms are there. The common stock that the employees have would be bifurcated. Stock that was considered earned for value that's already, performance that was already rendered, would stay common stock, just the same kind of stock the investors are converting into. But stock that the employees have for future performance, future value, would become a preferred stock, voting stock that doesn't trade. Subsequently, it converts from the preferred into the common based on the milestone.
The trigger.
So the big thing here is to replicate the valuation mitigation, reduction of value risk that VC and private equity firms have for public offering. And the way I'm doing it with the Fairshare model is to say, nobody can value reliably these venture stage companies at IPO. So don't even try. Figure out instead how you're going to define performance and how you're going to reward it. I said there's two big things that will come out of it. One is companies will have incentive to offer IPO investors a really, really low pre-money valuation. Because if one of their performance measures is a rise in the market value of the company, they want to start as low as possible. So if a conventional company were to go public and comparable companies were worth 100 million, you'd expect it to go out with a pre-money valuation of 100 million. If the Fairshare model was used, let's say this company is raising 20 million bucks. If the Fairshare model is being used, a company raising 20 million might go out with a pre-money valuation of 10 million.
Right.
Because they want to see that increase. As the secondary market value is being pushed up because investors recognize it as a underpriced asset, the employee stock is qualifying to convert into the tradable stock.
Okay.
So that's diluting the interest of the investors, which you think they wouldn't like, but they don't care because the value of their position is going up.
Yeah.
That's a big deal. It adds, normally companies going IPO attract investors based on the market they're in, the technology they're using, and the team. You still have those particular attractions, but now you have a new pheromone. It's a deal. That's a big deal, but there's a bigger one. And that is, it enhances the ability of a company to attract and motivate employees. But for example, let's say, Steve, and I had an IPO using the Fairshare model, and I want to hire you, and you have an offer from Apple. I'd say, Stephen, I can offer you a salary. It wouldn't be as nice as high as Apple's. I can offer you benefits. They won't be as nice as Apple's. I can offer you stock options on my tradable stock, and they have more upside than Apple's. But I can offer you something that Apple cannot. And that's an interest in my performance stock pool, which only has value if we as a team are delivering these particular
to execute
results.
on it. Okay. I like it, Karl. It's interesting to think through. So let's wrap up with this. You've got the book. We had it at the beginning. What's the best way for somebody to get in touch with you or to look or to find the book? And just wrap us out with some contact information here, and we'll see if we can share this with people.
Okay. The book's available in print and ebook. We're both, Amazon has it. Google Books has it as well. And in both locations, you can see a preview. You can preview the book. I think the more robust preview is Google Books.
Okay.
You check it, link in with me at LinkedIn. My email is Karl with a K at FairshareModel.com. FairshareModel.com is my website as well.
Perfect. So we'll have everybody reach out. And just so everybody knows, there are two Karl Sjogens out there. So when you look, make sure you connect with Karl on the Fairshare model, not the data analytics guy. I made that mistake earlier.
That's my son.
Well, he may be wondering why he thinks he's doing a podcast with me.
He used to work at Google at one point. We're both trying to get his pictures showing up on Google Books. And we've been trying jointly for about a little bit over a month to get them to use my picture instead of his. But I guess we're still tied at the hip.
Yeah, it takes a while. So, all right, Karl. Well, hey, I appreciate the time. Great information. I love the model because anything that can get investors a better deal and tie it to company performance, I'm all for. So,
well, you just say, Stephen, just to go back to how we opened up in terms of the economy and entrepreneurship and and the like. The thing that excites me the most about the Fairshare model is the potential to make capital for venture firms or venture stage companies more available, and to just sort of invigorate, introduce another level of vitality into the economy.
Yeah, the invigoration, the investor class, the projected return, because a lot of times by the point of IPO, the little guys are either, left out or holding the bag, and I think this is interesting. So we'll push people your way, Karl. Good luck with the book. Appreciate it. Love the background. All right, closing out. Steve and Meade, the Bullseye Guy podcast. See you next week.